Hello, and welcome to our webinar. My name is David Butler, and I'm the Head of Charities and Not-for-Profits at Bishop Fleming. Over the next 40 minutes or so, we're going to be talking to you about the importance of financial management and also highlight the things you should be thinking about to get your charity ready for 2021. It sure has to be a better year than 2020. And finally, there is some real cause for optimism. We have four speakers today. Emma Jane Daly from VWV Solicitors, and she'll be talking to you about trustees' responsibilities, highlighting the areas to focus on during these current times. And then you'll also be hearing from three of my Bishop Fleming colleagues, Luke Benner, Sally Timmins and John Sparks, who will be talking to you about financial management, good governance and tax considerations covering new business models. As with all webinars, at the end there'll be a session time for some Q&A. So depending on what device you're using, somewhere on your screen there's going to be a Q&A option. So please submit your questions that you have. We'll ask them at the end, but if there's a particularly pertinent question, we'll ask during the session. If you leave your name and we don't get a chance to answer your question during the session, then we can contact you after. But if you want to submit anonymously, that's absolutely fine. One last housekeeping point is that we're going to be recording this session, so you will receive a link to the video after the event, and please feel free to share it as you see fit. When we were planning this webinar, the prospect of a second lockdown seemed at a pretty distant risk. However, here we are once again, all at home in our houses and dealing with the challenges that many of you faced earlier in the year about how to manage your charities, how to provide services and how to effectively fundraise. Because what lockdowns do highlight is how critical it is to have a business model and a method of delivering services that is robust. Consequently, ensuring you have a sensible plan for 2021 to make your charities not only effective but sustainable is of utmost importance. Because for many of you, and I'm a trustee of a charity, it has been a pretty grim old year. Income's fallen, costs have increased, and there are restrictions in place over how we can operate. But at the same time, the charities sector is having to provide more and more services. The contribution that the sector is making to society is immense, but can this really be sustained when the impact of COVID-19 is likely to be felt for many years to go, and certainly a long time after the vaccine gets rolled out? The pressure on the sector is pushing more charities into mergers as weaker charities look for a safe haven. One recent report said that mergers were up by a third in the 3 months after the initial lockdown, but merging often isn't enough by itself. There have been a slew of job losses in recent months, and we're expecting more as we go into the new year. However, as I've said at the start, there is now genuinely some cause to be optimistic. The good news on the vaccine trial suggests that normality will return at some point. And in the meantime, the public, charitable trusts and foundations have done an amazing job of supporting the sector. The public donated £800 million more than they normally would have done during the first lockdown. And in addition, hundreds of millions of pounds have been made available by trusts and foundations, and not forgetting the government support that's been there as well. This all suggests that much of the sector will survive, but this cannot be taken for granted. The sector needs to be planning now to ensure it is sustainable and both financially and structurally fit to meet the challenges of 2021. So with that, I'll now hand you over to Luke, who will talk about financial management.
Thank you, David. Good morning, everybody. So yes, I'm going to be talking about some of the sort of key financial and business issues that you need to be considering throughout, and I mean, they're certainly beyond the pandemic. Some of these points will sound sort of relatively straightforward, but I think at a time when lots of organisations are going through a very difficult time, I thought it was important to sort of bring these into focus. So first point's around cash flow management. Again, it sounds quite straightforward, but we do come across organisations who don't forecast and sort of properly manage their cash. It is very important that forecasts are prepared and that you do continue to review those figures against actual performance. So look at your forecast and think about the cash position. Do they demonstrate that there's sufficient cash to trade over the next 6 to 12 months? Are you sort of confident in the income projections? Have you built in contingencies into your calculations? And this is all about establishing how sort of financially secure the organisation is. And when you're pulling these calculations together, consider how secure, how visible and how diverse your income streams are. If income lines are being cut, are there other avenues you can explore? And sort of think about how far forward you can reliably assess your future income. And to make sensible decisions about priorities, management do need a good understanding of the charity's costs, the types of expenditure, and how these are likely to sort of fluctuate. And clearly an organisation that talks about internal cost controls and benchmarking processes is more likely to be on top of its spending than one that is sort of too afraid to mention it. This extends to reviewing contracts, to procure services, and coming up with ways to sort of reduce costs. And whilst sort of talking about cost cutting, as David noted, it is interesting to note that charity mergers did rise by nearly a third during the first 3 months of lockdown. And actually a number of these charities cited the pandemic as the contributing factor. And this is all about charities working together to cut costs and help them meet the needs of their beneficiaries. And I think the important point to mention here is that the most transformative of mergers are those that actually are well thought out in advance, rather than those that are carried out as a sort of last minute rescue. Tying into that is the importance of effective working capital management, which underpins a charity's financial security. So think about your suppliers, think about your trade creditors, to determine if payment terms can be renegotiated. Think about your debtors, think about your key customers to determine if there's a risk of income streams disappearing, risk of significant bad debt, or perhaps whether you've already got debts that need to be recovered. We as a firm, Bishop Fleming, we work in partnership with a firm called Escalate, a third-party firm called Escalate, where we do offer our clients an entirely risk-free debt recovery and litigation process to assist you with recovering funds and resolving disputes. So if you've got issues, please talk to us. Think about your funding lines as well. Is now a common and sort of good time to restructure facilities or perhaps secure new debt? It is becoming increasingly common for charities to secure debt to perhaps develop assets, to fund growth, or maybe just provide working capital. And again, we can assist you with that process. The third point is around financial management, which is the ability of your organisation to sort of control and understand its income and spending, and balance the day-to-day needs with long-term objectives. So think about management accounts. Again, it sounds straightforward, but are your management accounts being prepared regularly? Are they being reviewed regularly against actual performance? They should track monthly and cumulative performance to allow the board and management to assess, firstly, if targets have been met, but secondly, if next year's budget has any relevance. So make sure you consider what the results show and sort of compare them with what was expected. And then there's the finance team. Is the finance team competent? Is it appropriate for the size of the charity? And on the subject of people, I mean, clearly people must be a key consideration. Look at your leadership team. Do you have the right leadership team in place? Does the management team bring a range of perspectives and experience? Is the staff profile adequate in the current environment? And sort of how vulnerable is the charity to personnel changes? And finally, are your people working towards one common goal? Is there a healthy culture? This is all very, very important stuff in what is a difficult time at the moment. And then finally, just a little bit around trustees' responsibilities. Do you as trustees, do you have a clear financial and operational strategy? And if so, are you regularly monitoring that? Are the trustees' responsibilities appropriate? Are they shared throughout the board, and are they made clear? And this all comes back to the general point of trustees and their obligation to manage and safeguard charity resources and generally speaking, act in the best interest of the charity. And if trustees fall foul of their obligations, then they are at risk personally. And of course, if at any stage trustees are concerned about the financial position of their charity, please do talk to us at the earliest opportunity. Not only will this help to ensure that we can guide the charity, but it will also help to ensure that we can guide you personally as trustees, so that you're clear on your personal obligations. That's me done. I'm going to hand over to Emma Jane now, who will speak in far more detail about trustees' duties and the law in more detail. Thank you very much.
Thanks, Luke. Morning, everyone. I'm Emma Jane Daly. I'm a partner in the charities team at VWV. And as Luke said, I'm going to sort of concentrate a bit more on the duties of charity trustees. And the charity trustees are the people who have the general management and control of the administration of the charity. And that's helpfully summarised by the Commission, as being those who have responsibility for directing the affairs of a charity, ensuring it is solvent, well run, and delivering the charitable outcomes for the benefit of the public for which it has been set up. And when advising charity trustees, which I do on a day-to-day basis, I always like to remind and refer back to what I call the fundamental duty of charity trustees, and that is to at all times act in the best interests and to safeguard its assets. And if at any point you're in doubt about how trustees or your board should be acting, if you consider it in light of that fundamental duty, it is quite hard to go too far wrong. And I'm going to look at some specific aspects of that. But before doing so, I think it's helpful to sort of go back to basics a bit and think about how trustees should carry out their role. And trustees must exercise their duties with such care and skill as is reasonable in the circumstances, and must use their own skills and experience in helping them to do that. And that duty will be greater if a trustee has, or indeed claims to have, special knowledge or experience, or if their business or profession means that they can be reasonably expected to have knowledge or experience of a particular area. And here we're looking at particularly at financial issues and financial management. So those trustees who have a background or experience of that will deem to have a high degree of care and skill. And of course, notwithstanding that many boards of trustees have a wonderful array of skills and experience on their board, it is rare to find a board that has significant experience of everything, or the right experience of everything. And it's certainly appropriate where a board lacks that experience to take advice on relevant matters where they should do so. I think it's probably incumbent on trustees where they know they are lacking a particular skill or experience to take that advice. And of course, it is right and proper for the charity to pay for that. And perhaps what the biggest role of trustees to do is to make decisions. And that is what trustees do, they make decisions. And in doing so, they normally will hold meetings and must do that in accordance with their governing instrument. And of course, and all the ordinary things you must look at when holding meetings to make sure they're valid, a quorum, and particularly in this climate, whether you can hold those meetings electronically. Perhaps more fundamentally still is how trustees make those decisions. And for many charities at the moment, there are very difficult decisions to make, particularly around financial management. Luke mentioned mergers, and that is something that's on the agenda for a lot of charities at the moment. And the Commission's guidance in CC 27 is pretty helpful in that regard. And what the Commission say is that charities are independent. The trustees are responsible for governing the charity and making decisions about how it should be run. Making decisions is one of the most important parts of the trustee's role. Some decisions are simple and straightforward, but others can be complex or far-reaching in their consequences. And the Commission's approach is that trustees should make decisions which are within the range of decisions that a reasonable board of trustees could make. It's not for the Commission or indeed the court to say what was the right decision or even the best decision, which of course we all know it's easy to do in hindsight. But it's about whether the decision that the Board of Trustees are making is within the reasonable range of decisions they could make. And the principles of good decision making are obviously key there. And again, I'd recommend having a look at CC 27. And the principles of good decision making are really around considering your duties and acting within your objects and powers. I'm going to talk a bit more about that in a moment. Acting in good faith in the interest of the charity. Importantly, making sure trustees are sufficiently informed to allow them to make those decisions. So making sure they do have the financial forecasts, the financial management information that they need, and they take into account all of the relevant factors when making decisions. And perhaps more importantly, ignore anything that is irrelevant. And of course, that they manage any conflicts of interest that exist when they're taking those decisions. So back to that fundamental duty to act in the best interests of the charity. And one of the key aspects of that is about ensuring that at all times trustees ensure that the activities they carry out further the charitable objects or purposes or aims, however you want to express it, of the charity. And again, trustees must be familiar with their governing instruments and the particular objects that are set out within them, and that'll depend on how you're constituted. So if you're a company limited by guarantee, it's going to be your articles of association. If you are a CIO, charitable incorporated organisation, then it would be your CIO constitution. And if you're unincorporated, it may be a scheme, a trust deed, or some other document that sets those out. And trustees should always be careful of what I like to call mission drift. And that's where charities change what they do gradually over time, normally to chase funding streams or to get availability for finance. And at the moment, there is a lot of charities looking for increased funding, having to change slightly what they do in light of the pandemic. So it's important to bear that in mind. And if what you are doing is already on the borderline of your objects, or you are looking to do things which might fall outside of them, then it will be incumbent on you to seek the Commission's consent, which will normally be required for changes to your governing instrument to impact on those objects to allow you to carry out those activities properly. And another issue that flows from this, and which we see increasingly where charities are facing financial pressures, is misunderstanding about funds that they hold on particular trusts. And those are often more restrictive than the overall purposes. And I know that Bishop Fleming will probably cover some of the accounting issues related to that. But just looking at some of the legal issues and what are restrictive funds, those are funds that are held for a more restrictive purpose than the overall purposes of the charity, and they must be used for that particular purpose. And again, if you think that you have difficulties there, it may be possible to look at widening those restricted purposes, but how that's done will, to a large extent, depend on how that restriction has been put in place. And another type of fund to be aware of are permanent endowment funds, and those are funds that are held by a charity that must hold the capital of the fund permanently, and only the income can be spent. And in some cases, the income can only be spent on, again, a more restrictive purpose. And we're increasingly seeing charities looking at ways to release permanent endowment, and there are statutory procedures that can be followed to do that. Again, the precise nature of that will depend on how the fund is constituted and whether you'll need Commission consent to do that. But again, if that affects you, or you're looking at rationalising smaller funds that you hold to release some funding for more general purposes, then very happy to talk to anyone that's doing that. And another aspect of advancing your objectives is what we call non-primary purpose trading. And that is trading that a charity carries out not to further its charitable objects, but to raise funds that are in turn then used for its charitable purposes. The classic example of that, of course, is charity Christmas cards. But I know I see, and I'm sure colleagues at Bishop Fleming do too, increasingly imaginative ways for charities to raise funds by carrying out trading activities. And where charities are doing that, they need to bear in mind whether it is appropriate to use a trading subsidiary, which is normally a share company established for that purpose and wholly owned by the charity, that will then transfer its funds under the gift aid scheme to it. And Charity Commission guidance about whether a subsidiary should be used really focuses on two things. Firstly, a subsidiary should be used where the trading that the charity is carrying out will exceed the small scale exemption. And that's an exemption which allows a charity to carry out a small amount of this non-primary purpose trade without being in breach of trustee duties or without incurring tax. And the precise amount of that's going to depend on the size of your charity. And the other area where they say that a subsidiary must be used is where that trading is going to be risky in any particular respect, and that's about protecting the other assets of the charity within it. So just thinking a little bit about the relationship that you might have with that trading subsidiary. And the important thing here is about ensuring that the relationship between your charity and any subsidiary that you already have or indeed may set up is an arm's length arrangement and is documented in writing. And this arrangement should deal with a whole myriad of different things, but probably most importantly, I think the issue of cost sharing or the payment of resources that the subsidiary uses that belong to the charity. There must be a mechanism for recovering that. And then other aspects of the relationship, like data sharing, people sharing data between those two entities, need to make sure it complies with data protection legislation. Use of any of the charity's intellectual property rights, so its name, often a subsidiary will use the name of the charity in order to trade, and that needs to be provided for, give sufficient control to the charity and ensure there's an appropriate means for charging for that. And then the issue which has been particularly important in the charity sector over the last few years is safeguarding. This used to be the realm of those charities that dealt with children or vulnerable adults, but as we all know now, that safeguarding duty the Commission have confirmed applies to all charities to safeguard anyone that comes into contact with them. And generally, that's something that you'll want to cover in that relationship. And then generally just ensuring that your charity has sufficient control over the subsidiary, looking at its articles of association. Generally, we would say that shelf company articles aren't appropriate in that case. So just looking to make sure you have that control. And finally, for me, there was one other aspect of legal issues that I wanted to cover in this session. And that, again, is something increasingly seeing charities do at the moment, and that's secured lending. So lots of charities looking at raising finance in order to manage cash flow or to enter into particular projects, be that one of the government-backed schemes that are available at the moment or just traditional bank borrowing. Wherever that is going to be secured over property, there is an obligation on trustees to follow the procedures that are set out in section 124 of the Charities Act 2011. And generally this requires trustees to take advice in writing from a person who's reasonably believed by them to be qualified by ability in and practical experience of financial matters on a number of issues. None of these are surprise issues about what the advice should be on. Firstly, whether the loan is in fact necessary for the purpose of which it's being sought, whether the terms of the loan are reasonable, and doing that obviously you have to have regard to the status of the charity as the borrower, and I would also say the climate in which you're borrowing in. And probably key to all of this is whether the charity can in fact repay the loan on the terms set out. And the last thing from me here is just to remember that banks will very rarely, well I say rarely, often we find aren't really au fait with the requirements that charities have when entering into secured lending and the certificates of compliance that they need to give with the duties under the Act. So just bear that in mind when relying on any paperwork, minutes and documents that the bank provide to you. So that's all from me. I'm going to hand over to Sally, who I know is going to talk a little bit more about trustee duties. Thank you.
Thanks, Emma Jane. We've had some really important information here today, so thank you to both Luke and Emma Jane so far. We've heard about the duties, considerations and fundamental importance of sound financial management, and obviously why we need to be keeping a real handle on financial health and the direction of the charity. I am a manager at Bishop Fleming, but I'm also a national leader of governance and I'm a charity trustee. So I understand the challenges from both sides when we're looking about how to apply these principles. What I want to talk to you about briefly are some key features of effective governance and how to know that we have the right people in the right place doing the right thing. And for me, that's about understanding the skills that are around the table and filling any gaps either by recruiting appropriately skilled trustees or co-opting that expertise in if we need to. Boards really do need to be able to answer the questions of how do we know we're doing the right thing, how do we know the information that we are receiving is accurate and reliable, and how do we know that we have the appropriate knowledge to be able to make those decisions. So seek expert advice if you need to fill any of those gaps. The overall responsibility for effective governance and the implementation of proper financial management does rest with the trustees. But of course, governance isn't just about the board of trustees, it's all those people charged with governance, and that includes the paid executives as well as the volunteer trustees. Everybody wants to work together to collaboratively work really importantly on the information at hand and make those key decisions. The information does of course need to be sound, accurate, and then once any decision is made, the really important part is to evidence the rationale behind that decision and what decision has actually been made. And I can't stress that enough. It's so important to record the why we made that decision, and of course the when. We've seen over recent months, circumstances can rapidly change, and a decision made on one day may not necessarily be the right thing on another. So circumstances do change, the decision could be different, and you need to evidence the why. Material circumstances do affect outcome of any financially difficult circumstances. So actually, if you do have a situation where the charity does encounter strong financial difficulty and you do need to seek some support with that, then the evidence within those minutes can really make a material difference. There are cases and can be cases where insolvency can happen really quickly, and trustees really do need to make sure that they're able to identify financial risks and plan as far as possible for managing these risks at an early stage. Of course, this makes the framework for identifying and managing risks absolutely crucial, and of course the overall structure of governance and understanding what those frameworks are to have that information reporting absolutely crucial. You do need to make sure that you have effective internal controls in place, as we've already heard, and monitor that progress against budgets and strategic plans. If you do need external support, then take it. We've heard that that's absolutely fine. You need to be make sure that you're aware of the financial position now and in the foreseeable future, because trustees have a responsibility to ensure that the needs of the beneficiaries are met. We need to make sure that the requirements of any funders about service delivery is met. And of course, that staff and volunteer resources are used effectively. Effective governance, being a trustee and good decision making, comes from knowing your limits, understanding your role, understanding what you're there to do, and knowing the skill set of the team, and therefore understanding when and where you need to take external advice to fill any of those gaps to support analysis of the situation. Evaluating your own effectiveness and your own performance as a board is really important. You should look at this annually, certainly internally annually, and look to support an external governance review every 3 years in line with best practice. An outside view can really help take a perspective and a snapshot on things, also to assess that progress against your strategic direction. So don't forget, we don't know what we don't know, and a third party really can help support understanding what that looks like. So I'm going to hand over to John now, who is going to talk to us about charity tax and VAT. John, over to you.
Thank you, Sally. Yes, I'm just going to pick up on some of the themes that my colleagues and Emma Jane have already been talking about, but with a tax angle. Obviously, we're in unusual times at the moment, and that's putting particular pressure on traditional income sources for the charitable sector. And in common with many businesses, everyone's looking to react and evolve. That may be looking at mergers or new revenue streams, as my colleagues have already mentioned. With regard to mergers, from a tax point of view, important to consider thinking about tax due diligence when you're undertaking a merger, in terms of the tax history of the other party involved. Are they fully compliant with their PAYE obligations? What's the impact going to be of the merger on things like the overall VAT position? What trading subsidiaries does the party you're merging with have? What's that going to mean for our overall tax affairs? Luke talked a little bit about looking to potentially borrow against property, and Emma Jane's also talked about secured borrowings on property. Of course, one other option that might have a tax implication is to sell a property. Typically, capital gains on sales of property would be exempt for a charity. The key, though, is that there's a proviso that the proceeds are used for charitable purposes. So don't forget that second proviso. Usually it would be possible to demonstrate that that's what's happening, particularly if you're reinvesting in another property. But essentially, from a trustee's point of view, you need to make sure that you're clear where that money is going. In terms of new income sources, again, Emma Jane touched on this from a consideration of primary and non-primary purpose trading. Certainly, I would encourage people to consider whether your articles are up to date. Emma Jane used the word mission, or the phrase mission drift. And I think that's an apt description, and certainly that can have tax implications if you are moving into new sources of income that might be non-primary purpose. If it's clearly non-primary purpose income, then obviously you'll need to think about a trading subsidiary if you don't already have one. I haven't got enough time to talk about all the nuances around setting up a new trading subsidiary, but if you are in that position, do please ask, because there are a number of tax issues, both direct tax and VAT, to consider. My colleague Wendy Andrews is sitting in the background in case anybody does have any difficult VAT questions. I can see that one has popped up, so she will be making an appearance in the question and answer session. But basically, from a VAT perspective, where you are looking at new sources of income, there are two key questions. One is to consider the nature of the income for VAT purposes. So is it business or is it non-business? If it's business, is it standard rated or is it exempt? Of course, where you've got different types of income for VAT purposes, that will also have a potential impact on your VAT recovery position. So that's the second question to consider. If I'm making changes to my income, what does that mean for my overall VAT recovery position? The other key area at the moment to think about is actually around existing trading subsidiaries. Emma Jane earlier talked around some of the governance issues in terms of ensuring that you comply with the Charity Commission regulations. The key implication here for tax is actually around that support, if it's a management charge or non-financial support, if you like, being recharged at cost, so staff time, use of resources. If it's financial support in the terms of a loan, then obviously that needs to come with interest and have a suitable element of repayment terms. There are charity governance and charity law issues with getting that wrong, but don't forget there are tax implications as well. All of our tax exemptions for charities are predicated on the income that's received being spent for charitable purposes. So where we are failing to deal with management charges or loans to trading subsidiaries that might be loss making, then there is a risk that we do have a loss of tax exemptions within our main charity. Unusual circumstances at the moment, obviously trading subsidiaries may require additional management support, may require additional financial support to keep them going. They may ordinarily be profit making, but where they've got changes in circumstances, you should certainly be reviewing the terms of your loans and the level of management charges that are being put through to reflect true cost. As I said, if that's not complied with, there is a risk of a tax charge in the charity. The other thing with existing trading subsidiaries is gift aid. Obviously, the way this is supposed to work in normal situation is that the trading subsidiary makes its profit, and it's got 9 months after its year end to pay its gift aid donation up to the parent charity to mitigate any corporation tax. The key company law point here, though, is that the gift aid payment is a distribution of profit under company law, like a dividend. So that means that you have to have sufficient distributable reserves in order to make that gift aid payment. Now, ordinarily, on a year-on-year basis, where a trading subsidiary is profit making from year to year, never an issue. Obviously, at the moment, we could have a situation where we've got a profit last year, 2019, 2020, but 2020-21 may be loss making. So where does that leave us with our ability to pay gift aid? Our advice at the moment is that you need to be very careful with this. A bit of profit modelling, get up-to-date management accounts. Luke earlier referred to the importance of good quality management cash flow projections. This is one area where you certainly will need to do that in order to model and look at whether or not your gift aid payment is actually feasible. If it's not, because you have got losses in the current year, then don't worry. HMRC are allowing provisional loss carrybacks to be made. That would allow you to make an early submission based on management accounts and projections for the full current year, and make a provisional loss carryback of your current year results against the prior year profit. So again, there's a certain amount of work involved in that. So again, you will need to make sure you have suitable management accounts and full year projections for the current year to be able to undertake that task. But all is not lost, but it does need some work and planning. The final point I'm going to make from a tax point of view is around individual donors. Everyone's been affected by the coronavirus pandemic, and to the extent that individual donors, their taxable income may well have been affected by that. It may well have dropped. It's a donor's responsibility to confirm to the charity that they've paid enough tax in a given year to support their gift aid declaration to you. So ultimately, it is the donor's responsibility rather than yours. However, I think it's sensible to suggest that it would be good to make early communication, clear communication with your donors to remind them of their responsibilities to let you know if their circumstances have changed, and that actually, if they haven't paid enough tax when they submit their tax return, HMRC could come knocking on the door for the tax that they've effectively allowed you to claim in gift aid. The tax ultimately is their burden, but I think it's fair to say that there's a reputational risk to the charity sector of not flagging this up to donors and making sure that they're aware of a potential implication if their taxable income levels have dropped. That's everything from me on tax. I'm going to pass back now to David for some final words.
Thanks, John. We've just got a bit of time now to answer some questions that have come in. So just want to thank all the speakers for everything you've said. It's clearly created a bit of debate. And before you go, John, there's a tax question that came in at the end, which was, I guess it comes from a bit of bitter experience. It says, what are the sort of new income streams which could have VAT implications? I sense a VAT implication in the background there, but I don't know, is that a question for Wendy or for you, John?
I think that's probably one for Wendy.
Hi everyone. Yes, no, happy to jump in and answer that one. Kind of a number of areas where charities do get involved in sort of business activities and create income that's got some VAT implications. I guess the three main ones would be, for example, if you start providing some consultancy services to customers or clients or other businesses, IT maybe, or HR or some other activity, that can be a taxable supply for VAT purposes, which means if you're registered, you'll need to charge VAT. And if you're not registered, you'll have to look carefully to make sure you don't exceed the VAT registration threshold, which is currently 85,000. Another area that can generate income and have VAT consequences is if you have some spare space and you decide to rent it out. It's likely that will be an exempt supply for VAT purposes. So if you are registered, that could cause you some issues with VAT recovery. And I guess the final area of sort of trading income, which charities usually receive, is less likely to be the case at the moment, and that's from things like catering and shops. Again, if you're doing either of those things, you need to consider the VAT consequences, but perhaps you're less likely to be doing that at the moment. Thanks.
Thanks, Wendy. We've had a question come in from Mike Taylor, who said, a report published the other day found that 1 in 10 charities went into lockdown with only a few days operating costs in reserve. Do you think the pandemic gives evidence to trustees that in general charities should carry more reserves, or do you think it's too early to say whether charities can carry too little or perhaps too much? Do you think the pandemic will provide a useful insight into what level of reserves charities really need? Because I'm happy to start that, and I don't know whether Emma Jane might have a thought on it as well. Certainly from my perspective, and talking with my clients, I guess I was a little bit disheartened when I saw that report myself. It was amazing how many charities had tiny amounts of reserves. I know, the charity sector things are tight, but that certainly highlighted how tight it is for some. It's certainly what the pandemic has done is made charities much more focused on what a sensible level of reserve is. I think it's probably too early to say whether the reserves policies they set were too high or too low. But lots of trustees for years have given almost no regard at all to the appropriate level of reserves. When we have conversations with them, as long as there's a bit of a buffer, they're happy. But I think a pandemic such as this has really focused the mind as to what the charities should be having as a buffer, and the importance of having that buffer has become really critical. Having the ability to provide services where your costs have gone up, those are essential things. That's exactly the reason why you have that reserve in place. There's a risk. Nobody was really expecting a global pandemic. I know it was on very few clients' risk registers, and so the potential costs of a pandemic are immense, and they're likely to dwarf any sensible level of provisioning. But I think if you're looking at positives, it is the fact that it has really focused the mind, and charities actually thinking about what it is they do, what they want to provide in the future, and to enable them to do that, what a sensible level of reserve is. Emma Jane, do you have anything to add on to that point?
I would really just echo what you've been saying there, David, because it absolutely has highlighted to trustees about what they should potentially be holding in reserve. I would also say that it's potentially is a little too early to say whether it gives any sort of definitive guide, because we're not entirely through it yet, and one will question whether we will ever actually know when we're entirely through it. But I think it has also given people a good cause to look at their risk registers and just consider governance around those issues as well.
Thanks, Emma Jane.
Sorry. Thanks.
Thank you. So we've got a couple of other questions, which the first one may be one for you as well, Emma Jane. So we've entered into some bank borrowing which is secured over a property. From what you're saying, it appears we would need to get some advice. Does this advice need to be external, or can it be given by our finance director?
Thanks. Yeah, the first thing to say there is that the advice needs to be taken before you enter into the security. So bear that in mind. And the second part about who can give the advice is it just needs to be somebody who is reasonably believed by the trustees to have that experience and financial expertise. And in a lot of the cases that I see, it will be the finance director or somebody internally within the charity that will give that advice. Often when charities are either entering into a significant loan or they are facing potentially financial difficulties, or they have a new finance director, it can be appropriate to take that advice externally. And I've certainly seen that done on a number of occasions in those sorts of scenarios, so that there can be a proper check and balance on the advice that's given in there. And some trustees will require that, but obviously it increases the costs associated with the bank borrowing. But it's certainly open for finance director to do that, but just consider whether that's right in the context of your own charity at that particular time, in the context of your current financial position and the obligations you're entering into.
Okay. Thank you, Emma-Jane. We've got time for a couple of other questions, and there's a definite theme here which suggests that there is a bit of a lot of financial pressure. So the first one says, what should I do if I have concerns about our cash position? Is that one for you, Luke?
Yeah, thank you. Thanks, David. But I think the first thing to do is make sure that you've got a detailed and well thought out forecast, because until you've got that calculation, it's very difficult to be sort of clear on where you are now and where the cash position is sort of heading. And obviously we can help you pull those together if necessary. And then once you have got a clear understanding of what the cash position is looking like, and what your requirements are, we can help you build a plan which might involve securing new funding. It might involve sort of restructuring elements of the charity, for example. It's all about being clear on what the numbers show, and then being clear on what the strategy is to make sure you can sort of work in the right direction.
Okay, thanks, Luke. And I think we've got time for one last question, which I can see as a tricky legal one. So I can pass it on to Emma-Jane. So we have a number of permanent endowment funds. Is it possible to release the restriction over them so that we can spend the capital?
Thanks. The answer to that is, in theory, yes. It's about ensuring that you go through the right procedures, ensuring those procedures are applicable in the context of the permanent endowment that you do have. And it's all about really ensuring that you can demonstrate it's in the best interest of the charity to do that. And the size of those funds will determine whether it's something you need to contact the Commission about and get them to agree to the process. But it's really, the answer is that there are definitely ways of looking at it, but it will be really on an individual's own circumstances as to the mechanism for doing that. I'm happy to talk to anyone afterwards that impacts them.
Thank you very much. I'm conscious that our time is now up, so just really last thing, I just wanted to thank all the speakers today, which for all their contributions. I certainly found very interesting, and I hope that you all did too. As I said, we'll be sending a video out to all of you so that you can share this. One of the things to highlight is that we have a charity knowledge hub on the Bishop Fleming website. So if you just Google Bishop Fleming Charity Knowledge Hub, there'll be lots of insights and blogs and bits of information which hopefully you and your charities will find useful. So other than that, I'd just like to wish you all a good day. Thank you.